Okay, let's continue our discussion of optimal portfolio choice and risk. Continuing our discussion on correlation, you remember correlation really has no impact at all on return. It only has impact on volatility. So the lower the correlation, the lower the volatility we can achieve. So as correlation decreases, the volatility of the portfolio falls. So what graphically, what does this look like when you think about two assets together? So here is graphically what happens to the risk-return relationship between two assets, in this case Intel and Coca-Cola, as we change the correlation. If the correlation was +1, it would be a straight line. There would just be a straight line relationship between risk and return for Coors and Intel. But as the correlation declines, as it gets lower and lower and lower, we get this curvilinear piece to the portfolio, you will, or the options of what relationship should we invest in. In fact, if correlation were -1, we could actually create a zero risk portfolio with two risky things. And of course, hopefully you realize that that can't exist. If the risk-free return is somewhere around 3.5% to 4%, that's zero risk. How can you create something with zero risk that's going to get 13%? Which would you rather invest in? Of course, everybody would want to buy the combination instead of risk-free. So that would drive up the prices of the combination, which would drive down the returns. And of course, the vice versa would be happen to risk-free. So without arbitrage opportunities, right? If those don't exist, then we can't have this -1 correlation. And indeed, it's difficult to perceive of two things that would be perfectly negatively correlated. So let's take a moment and just take a step back and think about investing. There's two ways you can invest. Typically, when we think about buying stocks, you think about buying, that's a long position, these securities. And of course, you make money when the stock price increases. But what if you are fairly certain that the stock price is going to go down? Is there a way to make money if the stock price goes down? And indeed there is. There's something called a short position. Essentially, in a short sale, you're going to sell a stock that you borrow from a brokerage. Now you owe them this stock, but you sold it today. So today you receive the current price. Now if you're correct and the stock price falls, you have to pay this stock back to the brokerage. So if the stock price falls, you will buy it at the lower price and then return the stock. So this is still the buy-sell relationship, except it's done in the opposite order. So again, if you think the stock price is going to go down, this could be a very beneficial type of strategy that you can follow. So again, here we have, if you borrow $10,000 and you invested that plus $30,000, right? So it's $30,000 minus $10,000. You actually have a $20,000 investment. How much did you put in Intel? Well, that's 30,000 divided by 20. That's 150%. And the amount that you short sold in Coke is -50. So if you add those two together, -50 plus 150, we have the 100%. Now what this does for choices is it expands opportunity. If you remember, we said if you're between the 2 points, here's Coca-Cola and here's Intel. Anywhere on this solid line are long positions or positive positions between both securities. But you can ultimately go out here and you could short sell Coca-Cola. That is, you could sell it today, take that money and add it to Intel, and then that would increase the potential returns that you could get on your portfolio, but it also would be increasing risk. So again, we can expand our opportunities in both directions to more efficient things and or to, down below here, things that are less efficient. But it expands our opportunities of where we can ultimately invest our money. So what happens as we add stocks together? Well, here's Coke and Intel, right? What happens if we add another asset? What if we add Bohr stock to this? Here's the connection between Bohr and Coke. Here's the connection between Bohr and Intel. And then this blue-red line, this is the efficient frontier that has all three stocks. So as we include more and more stocks, our portfolio, our choices, our efficient frontier is going to move to this upper northwest quadrant. So we would be getting to positions or find opportunities that have higher rates of return and less risk as we move along. So efficient portfolios are those with the highest possible expected return for a given level of volatility. They're on that northwest edge. None of the stocks are typically going to be on this frontier. A single stock cannot be efficient. It has to be a portfolio of stocks. We have to find ways to get to a investment portfolio that is comprised entirely of systematic risk with no company-specific risk. Again, seeing how this would fit, you can see that the efficient frontier is moving to the left, which means opportunities are opening to the upper left, which are higher risk, higher returns and lower risk. So let's think about adding another potential investment. What if we add investing in the United States government in something like a T-bill or a T-bond? What will that do to the potential portfolio? Well, if you think about the rate of return on a portfolio, where we have here the X's here represent weights, here's the amount that's invested in the risk-free rate, plus the rate of return that's invested in this risky thing. When you add those together, that would be the risk of this portfolio, or the returns of this portfolio. But how would we incorporate, how would we then calculate the returns? Well, the returns are calculated the exact same way, except the standard deviation of this risk-free asset is 0. So we have a very simplified equation, if you will, of the weight of the risky portfolio multiplied by the riskiness or the variance of that portfolio. Now, just to take a step further, how can we graph this combination or this collaboration of investments, if you will? This straight line represents investing in the risk-free asset. Now again, between the risk-free asset here at 0 and P, these are all positive connections or combinations, if you will, of portfolio P and the risk-free investment. Once you get beyond P, this represents a short sale. So you would be borrowing at the risk-free rate of return, taking that money, plus all the money you had to invest in the asset, the risky asset, and combine it all. So this is what we refer to as risk-free investment. And up here, we would be buying P, but we would be buying it by borrowing. And in investments term, that's what's referred to as buying on margin. So borrowing money to invest in a stock. This happens frequently. Quite frankly, it's the way most securities are purchased. So a portfolio that has a short position in risk-free is known as being a levered portfolio. Margin investing is a risky investment strategy. It is certainly riskier than investing in a stock portfolio. So to earn the highest possible expected return for any level of volatility, you have to find that portfolio that's going to give us the highest return trade-off based on risk-free investing. We're going to try to create, if I come back to a slide, we want to create this line that is the steepest line possible that's going to connect a risk-free asset with a single portfolio on this efficient frontier. That will provide us then with an efficient combination of portfolios. How do we find this portfolio that's the best portfolio for us to invest in? We need to calculate something called the Sharpe ratio. This is the portfolio's excess return. That's the return in the portfolio minus the risk-free return, and divide that by the portfolio's risk level, or its volatility, its standard deviation. So the portfolio that you can find of all the combinations of things that you want to buy, we can find the Sharpe ratio for all those portfolios, and you want to maximize that number. So by maximizing the Sharpe ratio, we're going to identify one portfolio right here that's tangent on this upper curvilinear function. Now this red line used to be the efficient frontier, but now we're combining this risky stuff with this risk-free, so we have drawn again this efficient frontier. Again, from this point, which is all risk-free, to this point, these are all long positions. You're investing in treasury securities, and you're investing in this efficient frontier portfolio. Anywhere to the right of this portfolio, then you're borrowing at the risk-free rate of return, and you're taking that money plus all the rest of the money that you have, and you're all investing in this tangent portfolio. This tangent portfolio, in theory, is what we would refer to as the market portfolio. So combinations of the risk-free asset in this tangent portfolio are going to provide the best risk-return trade-off. Everybody wants the best risk-return trade-off. So every investor wants to buy this risky portfolio, that efficient portfolio. Everybody's going to buy that. Now, how do they ultimately invest? What is their ultimate strategy? Since everybody wants this one risky portfolio, because it's the best of all the risky portfolios, you're going to combine the risk-free asset with that one risky tangent market portfolio. So conservative investors are going to be buying treasury bonds or treasury bills and buying some of the market portfolio, or that tangent efficient portfolio. More aggressive investors are going to be moving up that line. In fact, very aggressive investors will borrow money and take their investment dollars and all the money that they invested, and they will then put all of that into the tangent portfolio. What we see then in general is where you want to be, the investments that you want to make. In theory, everybody wants the same things. But everybody's portfolio will be different because everybody has a different picture or a different feeling, if you will, of how much risk they want to assume. So again, in the next part of this video, we'll continue this discussion on how you choose and how you pick between assets.